Hi everyone. We are now going to look at problem 429A. For chapter 4 on page 226, page 226. We are wrapping up the accounting cycle in this chapter. So remember, in chapter 2, we record our normal business transactions throughout the year. We post them to the T accounts in the general ledger. And when we're getting ready to do our financial statements, which has to be at least once a year, we create an unadjusted trial balance just to prove debits equal credits at this point. We then have to find any missing revenues and expenses that have not been recorded yet and create additional journal entries, which usually fall into one of 5 categories and are given the general term adjusting journal entries. These journal entries are also posted to the T accounts and the balances are updated. These balances then create an adjusted trial balance, which is what is used to create the financial statements. So that brings us through chapters 2 and chapter 3. So that could be one big chapter. Actually, chapter 4 could be included in that as well. We separate it out so that it's the ease of learning this entire process. But chapter 4 wraps up our accounting cycle, all the things that must happen in our accounting system in a given accounting year. So we are picking up with creating financial statements. So we have here Erickson Real Estate Appraisal's adjusted trial balance, and they ask us to first complete the income statement for the year. Now, an income statement is an income statement. We start with the company's name, the name of the financial statement, and the date line. And then we record revenues for the year, which are right off of the adjusted trial balance, $48,100. Each expense, salaries expense, interest expense, depreciation expense on the building, insurance expense, utilities expense, and supplies expense. Add those up. Total expenses are $57,600. So in this problem, we're seeing something different. We're seeing where our expenses are greater than our revenues, which, if you remember, when we subtract those expenses from the revenues, that is considered a net loss in the business, a net loss. But we still make our income statement. In requirement 2, it asks us to prepare the statement of owner's equity, and it says assume that there were no contributions by the owner during the year. So we start with the name of the company, name of the financial statement, statement of owner's equity. Again, we're showing how owner's equity changed over a period of time. The year ended June 30th, 2018. Since the owner did not make any contributions, the balancing capital is the balance as of the beginning of this year. We have not seen any companies already in existence during the year or a previous year. When there is a capital balance, so balance in that capital account as of the beginning of the period, that is from prior period or prior accounting years information. So Erickson Capital July 1 starts at $42,500. There's no owner contributions, but there is a net loss for the year. We're used to seeing a net income, which increases owner's equity. With a net loss, we're going to decrease it, the $9,500. We then subtract our last part of owner's equity, which is owner withdrawals, giving us our capital balance on June 30th of $5,700. And don't forget to double underline that. The next requirement asks us to complete a classified balance sheet in report form. Classified balance sheet means assets and liabilities are categorized or separated, classified as either being current or long-term. Current assets are assets that will be used up within the accounting year through June 30th, 2019. Current assets are listed in order of financial liquidity. So here you see we have assets. Current assets are then labeled, and then the cash asset Financial liquidity, remember, means those assets that can be converted to cash the quickest. So those that are closest to the form of cash are the most financially liquid. So cash is listed first, then accounts receivable. It doesn't really matter with office supplies and prepaid insurance which one you list first because they're on the same liquidity field. But once we list these assets, and these are your common assets that will be used up by the end of the next accounting year, you total them and label them total current assets. The next area of assets are long-term assets. Now, long-term assets have subcategories, and you've only seen one so far. It's property, plant, and equipment. But in your chapter, they talk about two other types of long-term assets. Assets you'll not only use during the coming year, but will also still be used beyond next accounting year. Property, plant, and equipment is the type of long-term asset that is tangible. You can touch it, and you use it in the business to produce revenue. And we've been introduced to these already. This company has land, building, and then you could see how this accumulated depreciation account now affects our building account. So on the balance sheet, we're going to put building less that balance in accumulated depreciation and report the net. We call that book value. That is the value of this building on our books. So we add the land and the book value of the building together, which is always cost minus accumulated depreciation. And that gives us our total property, plant, and equipment. So we add our total assets, total current assets, to our total property, plant, and equipment assets to get total assets. Now the other two categories of long-term assets are called investments. Investments are assets the company owns that they don't use in the business. They just buy them to wait for them to go up in value and sell them later. Or they may be savings accounts they're holding long term. Intangible assets are an asset that you cannot see. It's more of a legal right. And that's another category of long-term assets. And it is used in the business to produce income. Some common examples of intangible assets would be copyrights that protect an artistic creation, patents which create an invention or an idea, and trademarks which normally protect a symbol. So only companies who own those types of intangible assets can profit from them. The next part of our balance sheet, which looks different now. Liabilities are listed underneath assets. That's because we're doing a report form balance sheet. The balance sheet we are used to seeing where we list assets to the left, liabilities and donors' equity to the right is called an account form balance sheet. And that's talked about in your chapter. Either way of presenting your balance sheet is correct. It's really the preference of the company. So now we'll list our liabilities. Again, liabilities are listed between current and long-term. Current liabilities, which are most of your liabilities, are those that are due within 1 year from the balance sheet. So these liabilities must be paid by June 30th, 2019 for Erickson Real Estate. Accounts payable, interest payable, salaries payable, and unearned revenue are your common types of current liabilities. Unless a liability is listed as long-term, the assumption is it is current. So we're going to total up those amounts and label them total current liabilities. This company does have a long-term liability, a notes payable, probably a loan from the bank. So they'll label long-term liabilities and list it, then add total current liabilities to notes payable to get their total liabilities. So we're still presenting a balance sheet. It's just that now we're getting a little bit more specific and categorizing or classifying assets and liabilities when they have common characteristics. Current assets being assets that will be used up within a year. Property, plant, and equipment, a long-term asset that is tangible, going to be used beyond next accounting year and is used in the business. Investments, remember, are long-term assets we're holding, waiting for them to go up in value. And intangible assets are assets that are not visible. They don't have physical form, but are used in the business to produce revenue, like a legal right. Again, current liabilities are liabilities that will be due within 1 year. Long-term liabilities are liabilities that are due beyond the coming year. And then our last item, as always on our balance sheet, is the capital balance. We calculated that on the statement of owner's equity, which was $5,700. Add your total liabilities to your capital. Total liabilities and owner's equity of $82,900 equals total assets of $82,900. So now we're done with the financial statements. And when we're done with the financial statements for the year, we are really done with our whole purpose of doing accounting for the year, which is to summarize all the information into reports for decision makers. But we still are not done with this accounting year. The final part of the accounting year is to get temporary accounts ready to start accumulating information in them in the next year. So our accounts can be categorized between either permanent or temporary. And those that are put into the temporary category must be reset to 0 at the end of the year. We're only allowed to accumulate information in those accounts for 1 year, and when that year is up, we reset them to 0. The temporary accounts for any company are those that are on the income statement and their withdrawals account. So revenues, expenses, and withdrawals all must be reset to 0 at the end of the accounting year. The only way to reset an account or do anything to an account is through a journal entry. So we will now be completing 4 very standard journal entries every company must do at the end of the accounting year to prepare their temporary accounts for the next accounting year. The first closing journal entry is where we reset revenues to 0. What we mean by that is after this journal entry is posted, the revenue accounts should be 0. Now, when we were going through Chapter 2, all you do is focus on increasing the revenue, increasing, because you want to accumulate all the revenue. Well, at the end of the year, you want to decrease the revenue. We decrease the service revenue account on the debit side. So in a few minutes, we'll see this journal entry posting into the service revenue account. We credit an account we only use during the closing journal entry process. It's called the income summary. So we've just essentially moved service revenue out of the revenue account and into this other account called the income summary. The next journal entry would be to reset all of the expenses to 0 so that when you finish posting this journal entry, every expense account will have a 0 balance. Again, we're used to debiting the expense accounts to accumulate all the expense for an accounting period. Well, now we have to decrease each expense account individually on the credit side. So insurance expense, credit it for its balance of $4,400. Salaries expense, credit that balance for $33,500. Supplies expense, credit $300. Interest expense, credit $8,500. Utilities expense, a credit of $2,700. And depreciation expense on the building, credit of $8,200. You'll see in a few minutes when we post that journal entry, those accounts will in fact have a 0 balance. What we do to offset or debit is that new account we only use during closing journal entries, the income summary. So we have just reset each revenue and expense account to 0. And unfortunately, I can't flip around on my PowerPoint. So you just have to trust me that when we get to the T accounts and you have those journal entries in front of you, you're going to see this magic happening. Now, what I would suggest you do right now is create a T account with the word income summary on the top, and then post the first journal entry where we credit the income summary $48,100 and debit the income summary $57,600. In the third journal entry, we reset the income summary account to 0. So currently its debits are $57,600. Its credits are $48,100. The only way to get this account to 0 is to credit it for $9,500. You do the opposite to the capital account. And if you're looking at that going, I've seen that $9,500 before. Yes, you have. That was the net loss of the company. Think about what is in the income summary account. If we reset all the revenues to 0 and credit the income summary, the revenues are on the credit side of the income summary account, and the debit side of the income summary account are all the expenses for the year. So if there is a loss, your debits, the expenses, will be more than the credits. If there's an income, the opposite will be true. So be careful of that when you're working on your homework. Net loss decreases capital, and that's what we're doing here, debiting capital. And we've just reset the income summary account to 0. That account goes away until next year during the closing journal entry process. The final closing journal entry is to reset that last temporary account to 0, which is the withdrawals. Currently, the withdrawals has a debit balance of $27,300. We needed to have a 0 balance, so credit the withdrawals, $27,300, and debit the capital account. So those are your 4 journal entries that are completed when you do closing journal entries. There's no transaction information around them. Even in your book, it says journalize the closing entries. You need to know that's what we're doing here. Resetting all those temporary accounts to 0, including the income summary, and moving their balances into capital. So now I'm going to slowly go through. I'm not even going to be able to flip around a lot, but I'll bring your attention to each of the journal entries we just did. I apologize for the order of the T accounts. First of all, take a look on the left. Cash wasn't affected during this process. Accounts receivable, office supplies, prepaid insurance, land, none of those accounts that we have listed in front of us on the left are affected. But take a look on the right. Service revenue, you see it says CLOS, debit side 48,100. And then look at the income summary account on the credit side, 48,100. So there was our first journal entry. Now, unfortunately, I can't flip to the next slide to show you all the other expenses, but trust me on this. Each expense, and you can see the first 2. Insurance expense, there's the credit of 4,400. Salaries expense, the credit of 33,500. Take a look at those balances in those accounts. And each expense will be credited in that fashion. The debit goes to the income summary account. The income summary account then ends up with a debit balance of $9,500. We needed to have a credit balance, or a 0 balance. So we credit in the third journal entry the income summary, and when you see the capital account in a second, you'll see the debit going into that account. The final journal entry affecting the accounts on this page, the withdrawals. There's the credit to withdrawals. It now has a 0 balance. The capital will be debited. So let's keep going and take a look. Take a look, these assets accounts on the left, not affected. But see the supplies expense, credit of $300, interest expense, credit of $8,500. So posting more of that second journal entry. And then our final, whoa, that's really a disaster there, right? Array of T accounts. The remaining expenses are credited so that their balance is 0 on the right. Take a look on the left. None of the liabilities were affected. But take a look at the capital account. It had a balance of $42,500. During closing journal entries, we debited it for the $9,500 net loss that was in journal entry 3, and then we debited it for the withdrawals amount of $27,300. So once we subtract those 2 debits from the original capital balance, capital now has a balance of $5,700, and that should look familiar too, because that was the final balance of owner's equity, capital, you determined on your statement of owner's equity. So now it appears as if all of our general ledger T accounts that are temporary are ready for the next accounting year. The last final item we must do in our accounting cycle is another trial balance. That's the last requirement here. The last trial balance is called a post-closing. After closing, it means trial balance. So here's all the accounts with their balances after we updated those for closing journal entries. Take a look. Only assets, liabilities, and the capital account are listed. Yeah, because the revenues, expenses, and withdrawals all have zero balances, so you don't have to list them. So list each asset with its balance, including accumulated depreciation on the building, which is a credit balance, each liability, and then the new balance of capital. And really, the whole purpose of this final trial balance is just to prove debits equal credits in our general ledger before we start the next accounting year, because if they don't, we won't know where we went wrong. And remember, we always have to make sure debits equal credits, and each opportunity we have to prove that they do, we take it. So this is our final step of the accounting cycle. Just to refer you back on page 198 is a great depiction of the accounting cycle. It's a flow chart where it starts with, says start with the beginning balance. That's number one. So yeah, where did our account start at the beginning of the year? So these balances we see in front of us would really be the beginning balance for the year 2019. We then analyze and journalize transactions, post the journal entries to the accounts, make an unadjusted trial balance. Now, I don't teach the worksheet. If you want to learn it, I encourage you to look at it, but I just don't think it's as used as it once was. So I kind of bypass that and go right to adjusting journal entries, which were chapter 3. We post those to the T accounts and come up with an adjusted trial balance. We then have our financial statements completed. Then we complete our closing journal entries, post those to the general ledger, our post-closing trial balance. And that's the cycle we go through every single year. Every step must be performed. So that concludes the accounting cycle in Chapter 4. You are now ready to work on your project that is due by the end of the semester, and that is on pages 240 to 241. You only have to do comprehensive problem 1, steps 1 through 9, skipping step 4, and all it is an accounting cycle for Murphy Delivery Services. So there is a template in the project folder at the end of the course information area for you to complete this, and I encourage you to complete it as soon as possible since all this information is fresh. If you have any questions, please post them to the discussion board.